For the income tax part of FAR, there are two primary journal entries, first for current and second for deferred. In this video, we're going to go over the first journal entry for the current portion of income taxes. So what is current income tax? It's just the tax expense based upon the income for the current year, and it's calculated using this basic formula. Taxable income times the tax rate. That's all. So let's keep that in mind as we go into this first example. First, read the question and note what's being asked. You don't want to go through the whole problem and answer the wrong question. The question asks, what is the company's income tax expense current portion? On your board or on your Excel spreadsheet, write IT expense current. That should be a trigger in your mind. We need current income tax? Oh yeah, the formula. Current income tax expense equals taxable income times the tax rate. Now let's read the rest of the prompt. ABC reported taxable income of $190,000 for the current year. The current tax rate is 35%. Next year's enacted tax rate is 21%. We have our formula. Let's plug in our numbers. They give us taxable income. Great! $190,000. Next, what is the applicable tax rate? Here we have two choices, 21 and 35%. The $190,000 that we plugged in was for the current year. So which tax rate should we use? The current year's, 35%. We're not using 21% until next year. We want apples and apples, this year's taxable income and this year's tax rate. We have everything in the formula. Let's calculate. 190,000 times 35% equals 66,500. Answer C. So we've answered the question. Let's do the journal entry. Here we have current income tax expense, $66,500. This is the tax expense that we calculated based on our taxable income. We've incurred this expense and it's increasing. It's a debit, $66,500, and it's going to income tax expense current. What's the other side of the entry? Well, we owe this money to the IRS. When we owe money, it's a liability. Here, the liability is increasing. Credit, $66,500. Where's it going? Income tax payable. Okay, that's the basic calculation and the basic entry. Easy, right? Okay, so now let's shake it up a little bit. Let's add in some estimated tax payments. First, read the question and note what's being asked. Here the problem asks, what is the company's income tax expense current portion? Once again, on your board, write IT expense current. Now let's read the rest of the prompt. ABC Co. reported taxable income of $190,000 for the current year. The company made estimated tax payments of $15,000 during the year. The current tax rate is 35%. Next year's enacted tax rate is 21%. There's an added component in this example. Estimated income taxes paid. What's that? Estimated income taxes paid just means that instead of waiting until the end of the year to pay your taxes, you estimated and paid some of your taxes during the year. So if it's year 2019, instead of waiting for December 31st, 2019 to pay your taxes, you paid part of your taxes sometime in 2019. Now we're looking for income tax expense current. That should trigger the formula in your mind. Current income tax expense equals taxable income times the tax rate. Let's look to the prompt and see if they give us what we need to fill in the formula. Taxable income, $190,000. Great! They give it to us. We like that. Next, what's the tax rate? Well, we use the current year's taxable income, then we need to use the current year's tax rate, 35%. We want apples and apples, this year's taxable income and this year's tax rate. We have everything in the formula. Let's calculate. 190,000 times 35% equals 66,500. Answer C. What the? It's the same! Regardless of whether we paid part of our taxes or not, it does not affect our tax expense. The answer is still 66,500. You're probably wondering, what does the estimated tax payment affect? It affects income taxes payable, the amount that we owe the IRS. If you look back to our journal entries from example 1, our income tax payable was $66,500. In example 1, we didn't make any estimated tax payments during the year. Here, in the second example, we already paid $15,000 during the year. So we don't owe $66,500, we owe $66,500 less the $15,000 we already paid? Let's calculate. $66,500 minus $15,000 equals $51,500. That's our income tax payable amount at year end. That's what the estimated tax payment affects, the payable, the amount we still owe to the IRS. All right, just to recap, for income tax expense current, remember, the formula is taxable income times the tax rate. Now for estimated taxes paid, don't get tripped up by the words. Remember, it just affects your income tax payable. We already paid the IRS during the year, so we owe less because of what we already paid. And regardless of how much we already paid, that does not affect our income tax expense current. All right, the great thing about income taxes under FAR is that you will end up using what you learned for Reg 2. Learn it once, use it twice. Next, we're going to go over items that create differences between book and tax, starting with permanent differences. You want to rack up these points on the exam, so stay tuned, there's more to come. I'm Liz Cho with Test Prep in a Snap.